it's all a relative game. Currencies are all about relativities. So if the safe haven properties, the attractiveness of the dollar is declining, that in and of itself could potentially create reallocation flow into other currencies.
Today, as we are recording, it's the biggest euro-dollar move day upwards since Corona.
So let's just stop there for a second. So today, April 3rd, is the biggest move since the COVID crisis.
In euro-dollar that we've seen so far. So I have no idea where we are at the moment. I left the desk at 110.50. Not sure where we are now.
2.5 decades after the euro launched, is the single currency finally on the verge of toppling the mighty US dollar? Few can imagine a financial world which is not dominated by the dollar, but tariff-based trade wars and geopolitical turmoil have got people asking the question, is it time for the euro to play a bigger role? Welcome to This is Deutsche Bank, a podcast looking at news and trends in and around banking and finance. My name is Michael Steen, and in today's episode, we want to unpack what's actually going on with the foreign exchange markets, or FX markets, and look at how, amid all of this volatility, we at Deutsche Bank support clients. Today is the 3rd of April. Let's get started. Our first guest today is George Saravelos, our global head of FX research, and he's joining us from London. George, hello.
Good morning, Michael. Good to see you.
So welcome to the podcast. And now you spend a lot of time looking at the foreign exchange markets and currency flows, and there's a lot of news out there. But before we get into all of that, can you just explain a little bit about the dollar, its role in global markets, and what people mean when they talk about dollar exceptionalism?
Sure. Before I delve into it, thank you very much for inviting me to the podcast. And I have to apologize in advance if some of the quality of my questions is lower than expected. We've been up all night in research trying to analyze these historical tariff announcements from President Trump. So it really has been a historic day for markets. Let me go back to your question on what makes the dollar a reserve currency. We can distinguish it into two parts, the cyclical and the structural part. The cyclical is quite straightforward. It's that the US has done very well in economic terms over the last decade and more so. It's had superior economic growth rates, superior productivity. That's resulted in a high level of yields. So the dollar is a high yielder. It's resulted in the outperformance of the equity market. So there is a disproportional weighting of US stocks in global stock prices. And as a result, the market itself, market participants, are overweight dollar allocations. So that's the cyclical component of the exceptionalism. And then there is the structural one, the more enduring one. And here it runs across multiple dimensions. If we're thinking about reserve managers, central banks, the predominant allocation is to dollars. If you look at trade invoicing, for example, in commodities globally are priced in dollars. If you look at dollar funding, where do international companies issue? In what currency do they issue? It's in dollars, and you can see that in the FX swap market as well, and the famous Fed swap lines. You can then talk about the safety of US treasuries. The dollar is perceived as a safe asset. When bad things happen to the world, the dollar and treasuries tend to do well. That's where the world goes to feel safe. So it's many different things that add up to this picture.
Okay, so the world is basically running on dollars, and you mentioned reserves. I mean, the reserves held by central banks, that's I think about 57% are held in dollars and only 20% in euros. And there's long been this discussion of, can the euro become a significant player? What are the things that are, in terms of the cyclical and structural changes that we're seeing at the moment, that might put the dollar's role into question?
So I would say at the core of the big shift on the European side so far has been the German fiscal announcements. And here the thing to bear in mind is it was a surprise. The market did not expect these. And the speed was very quick in terms of how the decisions were made right after the election. And that's led to a couple of things being reassessed by the market and why you saw a very large reaction. The first one is you've had an upgrade in both German and European growth expectations. And as I alluded to, growth matters in terms of the attractiveness for a currency. The market has also felt that Europe is now becoming more proactive in terms of its fiscal response, and therefore the downside from tariffs reduces because Europe and especially Germany can respond. So that's the cyclical aspect. But I would say the structural aspect of the German announcements we've seen could potentially be just as important. This, for example, relates to an increased supply of safe assets. So there will be more Bund issuance over the next few years, and that is an issue that we will talk about in terms of the euro, the insufficient supply of safe assets. And then more broadly, and this is not just Germany, but the broad discussion around defense and competitiveness, if Europe is giving more signals and a policy shift around strategic autonomy, where Europe becomes more independent, that in and of itself increases the attractiveness of the euro as a destination. In effect, ultimately, it can become safer if you've got greater strategic autonomy. Now, things are moving very quickly, but it is interesting how that conversation has changed since the start of the year.
And that's something that you're really seeing. We touched on it in the last podcast when we were talking to Christian Ziering, this big announcement coming out of Germany and this hope that there'll be more sort of concerted European action. You're already beginning to see the effects of that, would you say?
You are definitely seeing that in the market response. You've seen very large rises in Bund yields. You're actually seeing a euro appreciation as well, which is quite unusual given the tariff announcements we have. And I think the European response, especially in Germany, is part of the story as far as the market moves go. Now, of course, there is the political discourse, how that's evolving. You are seeing the political discourse evolve as well, which I think is important at a European level.
Okay, I mean, now let's come on to the thing you've already alluded to, and I think I saw one of your notes landing at 4 a.m. or something overnight. The reason you had so little sleep last night is we had this big announcement out of the US from President Donald Trump with the tariffs on pretty much all their major trading partners. What is the role of that in this debate, and how is that changing people's view on the dollar?
So, markets always teach us to be humble. And if you had asked me that question 6 months ago, I would have said that undeniably this would have led to a much stronger dollar. And what we're seeing instead is very sharp weakness in the dollar this morning and in fact throughout the year. And why is that happening? I think the first is that the way the tariff conversation is being conducted and the way the policy is being executed is actually creating significant economic damage to the US itself. You can see that in higher uncertainty. That's transmitting through the US economy. Effectively, it's a big tax increase. As I said, tariffs are a tax increase, but at the moment, there's also a big debate in the US around the fiscal position. And the market is worried about a big fiscal tightening because that fiscal debate has not progressed enough. So we will see how that evolves over the next few months. And then there is the broader question of the dollar as a safe destination. And I'm sure we'll pick up on that later in the conversation. But if economic considerations that were previously very stable are becoming weaponized, that creates question marks to people in terms of allocating their money in the US. And I think that's starting to emerge as a consideration.
Okay. I mean, I framed the conversation so far very much in a sort of euro and dollar question. I mean, we're talking between Frankfurt and London, but of course, we're talking about the world as well. So what effect is this having on other currencies, and how does that play out? Is the dollar weakness seen against others as well, or what's your explanation and analysis there?
Well, in terms of the tariff announcement we saw overnight, there is a much bigger increase for Asian economies, China and Vietnam in particular. So you are seeing the market distinguish between those two things. So the currencies that are suffering a bigger so-called terms of trade shock, those are the ones that are strengthening less or weakening. But I have to stress that this is extremely unusual. In a normal situation, you'd expect a tariff shock to lead the dollar towards strength. So the fact that the market is distinguishing, but in a broader environment of dollar weakness, I would say is extremely unusual and very, very notable.
Okay, and going back to the top of the podcast and the question about the euro, I mean, is this just wishful thinking coming out of Europe, or do you think we're now going to see some very big structural changes in the euro's position as an international currency vis-a-vis the dollar?
So I think to answer that question, we need to ask, why has the euro failed to be as used as a reserve currency as the dollar? And I alluded to one thing before, the supply of safe assets. If you look at Europe, it's fragmented. The sovereign market is fragmented. Essentially, only bunds are perceived as a safe asset. Why is that? The absence of fiscal union, the absence of banking union. So this creates issues such as the sovereign doom loop. That is not to say that you can't move in an incrementally more positive direction. And I'd say that's where we are at now. If you have a more activist fiscal policy, you have an increased supply of bunds as a safe asset. If you see increased coordination within Europe, and this remains to be seen. It's early in the year. It's early in the debate. We don't yet have a German coalition government. But I would say at the margin, things are moving towards increasing the attractiveness of the euro. And if I look at it from a cyclical perspective, if the growth outlook improves, it raises yields. That makes European fixed income more attractive for reserve managers and others. And I look at it from a structural perspective, if strategic autonomy is increasing, that also improves the euro's attractiveness. I don't want to be too over-optimistic because there are still major challenges. This absence of a fiscal union, this absence of a banking union are really big concerns, structural concerns, which the market has. But if you do start seeing movements, and I think it's easier to see improvements towards banking union rather than fiscal union in the near term, all of that will incrementally add up and potentially attract capital into Europe.
Okay, so I mean, bunds, obviously, German bonds issued by Germany as a sovereign. But are you also saying then that you need to see much more European-wide issuance, joint European bonds issued by the EU or somehow countries coming together? And you've talked a bit about banking union and fiscal union. Of course, the other famous union is capital markets union, where we've seen some movement. Do you see that as part of the puzzle too?
Absolutely. Capital market union makes it easier to access, for example, equity markets. And there's different regulations across across listings across Europe. So yes, every little helps. Every incremental move, I think, increases the attractiveness. But I would say, in terms of the end destination, banking and fiscal union are the critical ones. I'm not sure we will get there quickly, or maybe not at all, given all the challenges of nation states. But it is important to acknowledge that it's all a relative game. Currencies are all about relativities. So if the safe haven properties, the attractiveness of the dollar is declining, that in and of itself could potentially create reallocation flow into other currencies.
Now, at the beginning of March, in one of your notes, you said that we need to acknowledge the possibility of the dollar losing its safe haven status. And you've mentioned the safe haven question already once in this conversation. Do you stand by that view?
I do, and my worries around that have probably picked up since we published that note. I would think about it across two dimensions. The first one, and this is a very relevant consideration for our clients who speak to FX, is this correlation between the dollar and equity markets. So historically, what you have seen, at least over the last decade, is when the equity market sells off in the US, the dollar would tend to rally. And therefore, if you're a foreign investor invested in the US, you're protected because as the dollar rallies, you're getting a revaluation in euro terms and you're protected from the equity drop. Now, what we've seen over the last few months is that dynamic's changing. US equity market is selling off and the currency is weakening. So investors are experiencing much larger losses on their underlying unhedged dollar assets than what they would have been. Now, to the extent that continues, that significantly reduces the incentive to allocate into the US because that safe haven property, the correlation property reduces. So I'd say that is one element that's very important. But then there's the broader structural element. And this relates to the question of safety. Are US assets safe? And you can talk about credit risk, of course. But I would say when investors think about the US, they think about open capital market, open access. You can go in and out. The communication from the administration, this discussion around, for example, potential Mar-a-Lago Accord, the discussion around Greenland, all these things do put into question market access, and I think is a bit more of a medium-term dynamic that's undermining this perception of, is the dollar really safe? And I think it could become a big theme over the course of this year.
Okay, thanks a lot, George. That's absolutely fascinating. And I think there's going to be a lot more to hear and watch on that topic in the coming weeks and months. And I should mention that here at Deutsche Bank, we have a sister podcast from DB Research called Podcept, which is available in German and English and available wherever you get your podcasts from. Listening to George in London, I'm very happy to say that here in Frankfurt, I'm joined by Verena Kruse, who's our global head of FX liquidity sales and European head of FX sales within the ICG group. Verena, welcome to the podcast.
Thank you, Michael, for having me.
And first of all, George is from research, obviously. I've just read your impressive title. Can you explain what it means and what you do?
Of course. Let me start on explaining what does ICG mean. ICG is for the Institutional Client Group within the investment bank from Deutsche Bank. And that means within my team, within the European team, for instance, that I run on the sales side, we cover any client that is a real money client, insurance names. We also do family offices, banks, central banks, sovereign wealth funds, hedge funds. So basically everything except the pure corporate flow, because that's on the private side within Deutsche Bank.
Okay. Wow, fascinating. All right, now, first question, before we get into the other topics, I really would like to know, because you have a career behind you, literally trading on FX markets, and I think everyone probably listening and watching has that image of from films or maybe TV series like Industry, what it's like. Is it like that on an FX trading desk, or can you just describe it a little bit?
Okay, don't believe everything you see in the movies. But I do have to say, when I started my career, that's about 20 years ago, and I was the first time as an intern on the trading floor, and I entered the trading floor, and to be honest, I actually wanted to do a box ticks exercise of having the trading floor on my CV. I entered and I fell in love. I love the environment. It's fast moving, it's loud, it's international, it's inclusive. It's just like you go in, you can't plan your day because there are news popping up left, right, and center. I really, really love that. And that is something that is portrayed in movies as well. I can say before my time at DB, so before the crisis, the financial crisis in this instance, I did see a telephone flying through like the monitors because the trader did get something wrong and was upset.
Oh, wow.
But yes, that was back in the days. You will not find that now. It's a lot quieter on the floor, but it's still noisy. So if you are used to going into an office, be by yourself, that is not what you find. You do still find people asking and being loud and asking for a price on the trading side. You have discussions, you have monitors on because you hear the news. So it is always, there's always action and something is happening.
So it's an intense environment, sitting in front of these screens, people asking each other for prices, that all still happens, but there's more kind of digitization now, and you don't have to do everything on a phone, I guess.
No, exactly. So that also moved on. So we are away from the phone. Of course, we have stands. So we are based in Frankfurt. We have trading in Frankfurt, but we also have trading in London. We have it around the hubs, New York, Hong Kong, Australia, you name it, we are there. So I can communicate with all of them either via chat or I can communicate on the stand on the phone, so I don't have to shout all the time, and I don't have to pick up the phone either. So it's all speed dial basically.
Okay, wow. And now we've already talked about some of the shifts in FX markets with George, but can you talk us a bit through the scale? Because I remember when I started my career as a financial journalist, we were taught, FX markets, that's $1 trillion a day. I think the number's a lot bigger now. Bring me up to speed.
So so the number is quite a lot bigger actually. So according to the BIS study, which is a neutral study on the FX markets, it is daily trading volume of over $6.5 trillion a day. And I would consider that Deutsche Bank has won like a large market share on it and being one of the most important liquidity provider in the FX world there.
Okay, I mean, you're based here in Germany, and we've talked a bit about how the announcements made by the government here are causing some big changes. But we're also a global bank, and you pointed out we've got traders everywhere around the world. How does the global reach matter in these kind of markets? And since it's such an important business for the bank, what does it mean to be a global bank, and how do you do that?
It's a good question, because we're the house bank. So obviously Germany is our core market, or all of Europe is our core market really. And the expertise on the German fiscal package that George touched on earlier, obviously we were one of the first banks calling for a turn in the euro dollar, for instance. We got that right, clients really like that. But because we are so locally present, we are able to go into the global outreach. So it's not just German focused. So we had in the press recently Turkey. So right after that was on the press, we had a call set up with the Minister Simcek, for instance. And that is because we are locally present there as well, so we can do the global outreach. So I think the combination of the local expertise is very important for our clients. On top of this, I find one thing very interesting to note, like all our clients, a lot of them have large banking panels, and a lot of the banking panels are with American banks. And over the recent years, I feel that they more and more want to partner with European banks, and there Deutsche Bank is obviously a natural fit.
Oh, I see. So just explain that a little bit more then. A banking panel, that means, is that the banks that they regularly do business with? Correct.
So those are the banks that they trade FX or other products, because we service other products, but I do FX. And they have a list of banks that they talk to, work with, and trade with. And we've increased our footprint even more throughout the years to open more of these clients, and they added us to their banking panel.
Okay, so I think I read or heard somewhere recently there's this cliche of FX markets only being able to digest one piece of news at a time, or concentrate on one piece of news at a time. I mean, given everything that's going on around us now, we've touched on two of the very big topics already today in this podcast. How do we go about servicing clients globally, and what does that look like?
I actually find the cliche really funny, because I thought it was always the cliche that men are not able to multitask and women are multitasking, which is also cliche. But yes, indeed, there are so many news always coming out. It's hard to really track them down, but that is the part of a sales to get it right, that you should know what your client is interested. Don't blast them with every single tweet that you're seeing, or every single news you're seeing. You should know what their core concerns are, which currencies exposures of interest, and tailor make it for them. Because only when you understand your clients truly, you can actually have these dialogues with them. You can bring your partners. You can travel with George, for instance, on the research side, and I often do, so does my team, to have discussions. You can bring structuring along, to have, or trading along, to really go in depth if they want to have a problem-solving part. So it's really listening to your clients, what they need. So it's not like one-fits-all approach kind of thing.
Oh, I see. So, and also, so just to understand that a bit more, a big client could come to the bank with a challenge that they have, and then it's up to us to find the right ingredients for how to deliver that, of which FX might be a significant one. So it's not just purely sort of buying, selling currencies, is it? Or
no, well, it's kind of like understanding what they need in FX. So there are certain clients that have their own, they are so large, they have their own trading desk, they have their own analytics. So obviously we can give them data on top of what we have, because we are a big player in the market, so we have more data than our clients do. We help them educate in the sense, but we also have clients that actually don't want to deal with the FX on top and have the hedges and actually want it automated. For instance, we have a house FX approach, which is FX as a service. So the client gets all the rules that they want to put around it, but it's all automated. So FX can also be a service. It doesn't need to be the pure macro trading, the intraday trade ideas that you normally have with like the macro community, hedge funds or asset managers. It can also be a service.
Okay, I mean, you've talked about how the market's got so much bigger in the time that you've been working in the market, and it's got more electronic. What are the trends then in terms of, because I find it fascinating that there still is this role for talking and communicating as people, but there's also obviously a lot more automation and so on. Where do you anticipate that going in the next years?
Okay, so I think the role of a sales will stay. It's just like you do have shifts. You have more e-sales, for instance, less voice sales. That is one part. When I started, there wasn't a role of an e-sales. But the one really core thing is when there is large transaction, really dedication, no client will just click and trade and not think about it. And also there are jurisdictions that they don't have the insights, but we do as the bank. So we are there to help. So and we can help also on optimization. So we have the hedging strategies. So take a look on euro-dollar, how we started the year. Everyone went long dollars. Basically, that was the start of the year. Then we turned.
And they went long dollar because on the expectation that the dollar would strengthen.
Exactly, as you heard from George.
Yeah.
And then it flipped. And today, as we are recording, it's the biggest euro-dollar move day upwards since Corona.
Let's just stop there for a second. So today, April 3rd, is the biggest move since the COVID crisis.
In euro-dollar that we've seen so far. So I have no idea where we are at the moment. I left the desk at 110.50. Not sure where we are now.
Okay, well, you've mentioned dedication, and thanks a lot for the dedication in coming in on such an incredibly busy day. Before I let you go back to what is an incredibly busy desk, I imagine, we do keep asking. We like to ask our guests on the podcast, what is one thing that you're dedicated to in your daily life?
So dedication in your daily life towards family and work, obviously, generically. But I would say one thing that I find is super important is respect. You should respect your parents, respect your colleagues, your bosses, your clients, your friends, like really treat everyone the way that how you want to be treated. So I think if you want to take one word away, that would be respect.
Very nice. Turning to you, George, what's one thing that you're dedicated to in your daily life?
So I'll drop into being working in research and liking to speak a lot. The first one is trying to squeeze in a bit of exercise every day. Usually it would happen by running back home or coming into work running to clear the mind. And the second is always trying to have dinner with my family, my 3 boys and my wife. It's always the noisy highlight of the day.
Excellent. I've got to ask one quick follow-up, which is how long is the run into work or on the way home?
I have multiple choices depending on the route. So depending on how busy the day is, it can be anywhere from 15 to 40 minutes.
Very good. Thanks again.
Thank you very much, Michael. It was great to be on the podcast.
Verena, thank you so much. It's been fascinating, and thanks, of course, to George in London. And thank you for tuning in to This is Deutsche Bank. If you like what you heard, please do subscribe and give us a like and a rating. And we will be back next month with another episode. Until then, bis bald.